Guys, the Magnificent Seven currently makes up 36% of the market cap of the entire S&P 500. To put that in perspective, the last time we had a major bubble burst because of stocks was in 2000. And at that point, the equivalent Magnificent Seven made up only 15 or 16% of the entire S&P 500. Now, these 7 companies, though, I think are far better companies than the 7 back in 2000. These companies have better balance sheets, better stories, and better futures. So let's get into that right now to break down the Magnificent Seven. So guys, these 7 companies right here, here's how they performed in 2023. NVIDIA was the biggest gain of 239%. Meta, 194%. If you remember Meta, it hit a low on November 4th of 22 of $88 a share. Go look it up now. It's incredible. Now, Tesla was once the amazing darling of the world. It hit a peak of $414 a share, hit a low at the beginning of 2023 around $100 a share, and skyrocketed, growing 100%. Amazon, make the sellers of everything, up 81%, Google up 59%, Microsoft 57%, and Apple 48%. Guys, it's no coincidence that the 2 biggest companies by market cap grew the least amount, and the one that had the most growth to do, because it was smaller, grew the most. Now, where did this term Magnificent Seven come from? So it's called the Magnificent Seven because of Bank of America analyst Michael Hartnett. He is the one giving credit to labeling it Magnificent Seven. But it's from a 1960s movie by the same name, The Magnificent Seven, which starred Steve McQueen. Now, there was also a movie in 2016 with Denzel Washington, Chris Pratt, and Ethan Hawke. So it's a fairly new name. Again, it was only coined back in 2023 for these 7 companies. So let's look at these companies in reverse order to discuss their story. Apple. Guys, everybody in this world is attached to Apple. I don't care what it is, even if you're anti-Apple like Nick here, attached to Apple. Microsoft. Guys, this is actually the only company from the top 10 in 2000 that's still here today. And if you remember, Microsoft hit a peak of like $50 or $52 a share back in 2000 and fell all the way to 11 or 12 bucks. And if you'd been able to buy it back then, in the early 2010s, you would have made a killing on there. Now, Google. Google was around in 2000, but it wasn't Google itself. I remember the first time I heard about Google.com. I was in college singing the fishbowl at the University of Michigan, and a friend of mine named Chris said to me, I was looking at Yahoo. He said, you use Yahoo? I use a site called Google. I said, let me check it out. Never turned from there since. You're watching on YouTube. YouTube is owned by Google. It was purchased in 2007, I believe. And guys, our analyst Dalton, his stepdaughter Emmy, she is 9 years old, soon to be 10. She watches our YouTube channel. And last night on a phone call, as she was saying hi to me, she even said, every investment is the current value of all future cash flows. It shows 2 things. 1, anybody can understand these things. And 2, get your kids started early on learning about finance. Yes, they might not understand it fully, but get them immersed in it so it's not something foreign to them when they're 25 or 30. Hi, Emmy. Thanks for watching the videos. Another company, Amazon. Guys, I don't even know. I think I met one person ever who's never bought anything on Amazon. That was 3 years ago. Ironically, it was an Amazon delivery guy. Isn't that weird? So Amazon's a seller of everything. I remember Amazon was incorporated on my birthday in 1994, I believe. And I remember reading an article in college about Amazon in which Jeff Bezos said, I want to sell everything, including washers and dryers. Now I thought to myself was, how are you going to ship washers and dryers? Don't listen to me about innovation. Tesla. Guys, this company changed the world of autos. They made EVs. They put them on the map. You can't drive it all today without seeing an electric car. I have an electric car. I used to have a Tesla. I no longer do. Mo has a Tesla. They make great cars. They are running into some problems right now. However, I believe in Elon Musk. I believe in Tesla, and I think they'll get through them. Again, from a qualitative aspect of these companies so far, that's what I'm discussing. Guys, Meta, Instagram, WhatsApp, Facebook, all of these companies are owned by Meta. 3.5 billion people every single month. That's almost half the world's population use their services. And I'm quite sure as they grow, it'll get even higher. It's an incredible company with a lot of upside potential on revenue. And finally, guys, NVIDIA started in 1993. Current CEO started the company. Guys, back in the 90s, I was a computer nerd. Back then, we knew how amazing NVIDIA's graphic cards were, and they've only expanded their product line. Incredible company, incredible products, attention to detail. When you buy an NVIDIA I've never heard anybody complain about NVIDIA products. Doesn't mean they don't, because there's complainers about everything out there. But from a qualitative perspective, guys, all of these companies have amazing stories. They're all amazing companies. But remember, company and stock are different things. It is possible to overpay for an amazing thing. In fact, a lot of times people will overpay for the story because they're so wrapped up in the story. You look at the revenue growth on NVIDIA in the last few years because of AI, it's incredible. These guys were on the forefront of the AI chips. They are selling expensive-ass chips to people. I believe Meta alone bought in the billions of dollars worth of chips from NVIDIA to help with their AI. These are incredible, incredible companies. But again, I want to stress, the question is, what is the right price to own these companies? Now, for those of you who know our channel and watch our videos, we have our 8 pillars. And in our software, guys, what we have is our 8-pillar portfolio. What this allows us to do is input up to 500 stocks into this, and it'll tell us as a whole, as if you owned one company, how would it look? So let's input all of these companies. NVIDIA, added. Microsoft, added. Google, added. Look how easy this is. Tesla, boom. Amazon, boom. Microsoft, already did that. Meta, boom. And the big mamma jamma, Apple. So we're going to get the stats here. Now, guys, this is how this all looks. Shares outstanding is probably skewed by 1 or 2 companies here. But overall, guys, look at this. High return on invested capital. Revenue growth is insane. Net income growth. Here's what I love so much. Free cash flow and net income are so close to each other. So close to each other. Very little dividend, which I'm okay with because these are growing companies with a lot of reinvestment opportunity. So I'm okay with this. But look at these return on invested capital. I mean, absolutely ginormous. Guys, the one thing I love about 2024 and the Magnificent Seven versus the top 10 companies of 2000, this part right here, the debt levels. Companies have gotten a lot smarter about managing their debt. As we get to be more service and technologically oriented as an economy, we don't need as much debt. That's what I'm loving right here. This metric right here says that these companies as a whole can pay off all their long-term liabilities with just 2 years of their last 5 years of free cash flow. That's an amazing stat. And that's what I want everybody to focus on in terms of being able to last the test of time. Look at a company like GE, which was a top company in 2000, had so much debt. You look at AT&T, had so much debt. It bogged them down. It hurts the company. To run a great company, you don't need a lot of debt. And that's what I want us all to focus. This is actually a quantitative aspect of the companies that I love. Great balance sheets. But 5-year PE, 49, 5-year price of free cash flow, 52. Guys, these are the largest companies out there. And the question you have to ask yourself is, are there future prospects financially good enough to justify these really high valuations? It's one thing if it's one company, but to have 7 companies combined have these 2 metrics together, that's a lot. Let's break that down a little bit more overall on these companies. Before we get into that, these are the 1, 3, 5, 7, and 10-year returns on Magnificent Seven. Now, I sorted this. I have Berkshire Hathaway and Eli Lilly because Tesla is not one of the top 7 market cap stocks. But look at this. Look at these numbers, guys. Look at these numbers. Microsoft, number 1, 1 year, 3 year, 5 year. We're talking about hundreds and hundreds of percentage points. Even in the 10-year price, look at this one. The worst 10-year return in the Magnificent Seven is 394%, and that's Google. That's Google. That's the worst one over the last 10 years. Guys, these companies have flown, but I want you to remember, just because the company does well in the past doesn't mean it's going to do well in the future. Stocks are a voting machine in the short run, a weighing machine in the long run. This long run shows these companies have really fundamentally gotten a lot better, and that is true. But the short run, the 1 year, that's the question. We saw NVIDIA jump up 230%. That's a lot for one company, especially one that's already in the hundreds of billions in market cap to grow. Let's go look at their individual price of free cash flow and relative to the market. Again, these are the top 10, get rid of Berkshire Hathaway and Eli Lilly. Eli Lilly actually doesn't have positive free cash flow in the last year, ironically. Their price to free cash flow, 45.8, 27.9, 27, 55, 100, 28, and 150. Now, how does that compare with the S&P? Well, if you exclude these companies out of the S&P and look at the other 493, the price of free cash flow is 24. These companies are 38 on a weighted average. 24 versus 38. Again, in and of itself, that doesn't mean it's going to be expensive. And let me give you an example why. If I came down and I said to you, hey, Paul, I know everything in the future, and in the next 10 years, all these companies are going to grow their free cash flow by a factor of 10. Absolutely, this is cheap. 100% that's cheap. And I would buy it all day long. But we don't know the future. All we know is what has happened in the past when things are overvalued, when things disconnect price from the story. That's the question we have to ask. And in this situation, there's a lot of hype and a lot of excitement and a lot of story built into these prices. Look at Tesla. Tesla hit that high of $414 a share. And literally people would argue with me saying, Paul, I'm betting on Tesla for the future. Now Tesla's sub 180. It hit as low as 100. And now people are changing their story on Tesla. Well, Elon Musk got distracted. That's the point, guys. Things happen along the way. It is too difficult to make all the rosiest of assumptions and assume it's all going to work out for the best. That's too difficult to do in your personal life over a week or monthly basis. Imagine multi-billion-dollar corporations over a 10-year period of time. It's very, very difficult. And Tesla is down from its all-time high of 414 to 180 with a lot of momentum going down on it and a lot of negative stories going down on it. They're talking about layoffs at Tesla. That's something we didn't hear about before. They're talking about manufacturing problems. They're doing recalls like crazy. Things don't stay rosy forever. You cannot find a single company that stays rosy forever. Even Microsoft. I tell this story all the time on this channel. In 2011 and 12, when I was buying Microsoft stock, a tech CEO told me it was dumb because Microsoft was dead. I guarantee if I asked that tech CEO today about it, he'd say, no, I never said that. Microsoft's one of the best companies ever. And I remember exactly where we were. I remember how it all happened. That's the point. News follows the stock price. Eventually, people get fed up with the news. They move on. That's what's going to happen at some point on these bigger names. Doesn't mean these companies won't do well over the next 10 or 20 years. Doesn't mean fundamentally they won't do well. But will the stock price match it if they're already based on the rosiest assumptions? Another story I always give, 2 amazing stocks in 2000. You were crazy not to own these 2 stocks. One was going to be the first $1 trillion company. One was the leader in chips. You were literally stupid if you did not own these stocks. I remember watching a TV show in which a woman was asking a guy, are you sure your portfolio is good? Yeah, it's great. Do you have Intel? I sure do. And she goes, oh my God, I'm so turned on right now. That was the premise of the show. So the 2 stocks I'm talking about here, the first one is Cisco. This was considered going to be the first $1 trillion company. Look at this chart. All-time high, March 27th, 2000 at $82 a share. It has not hit there since. And this is not a company where revenue and profit have fallen. Revenue has gone up 2 or 3 times. Profit's gone up several times. The company, if I told you back here that 25 years from now, the company will make 3 times more revenue and multiple times more profit, where would the stock price be? Very few people would have said here. Very few people would have said here. Intel was the same. Hit an all-time high in 2000, around $75 a share. It has not gotten any, well, it's got a little closer than 20%, but 24 years later, with several times more revenue, several times more profit. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. And these Magnificent Seven have both had weighting behind them. They've all gotten better as companies. They've also had a lot of voting behind them. That's the one that can turn very, very quickly. That's what you have to be careful for. Guys, even before Mo became a value investor, he had bought Apple because he loved the company. Didn't have a process for it, and his basis is $17 a share. This guy is up 11 times on his money. So just like him, I'm sure there's a lot of people out there who hear me going, hey, that makes sense. I already bought some of these companies. Do me a favor, share below some of the information you have. Like, what have you bought these companies at? What dates? I love those success stories because I told Mo, even though we think Apple might be overpriced today, don't sell it because you're going to pay too much in tax, where if it fell that much, you just own the company anyhow. So I'd love to hear success stories, people who bought NVIDIA 5, 10 years ago. Share them below, and thank you very much for watching our video.